What's not upside down is the stock market, right? Dow hit a new high today. You've said for many months, as far, frankly, as I can remember, Lee, that the market's fairly valued. Is it fairly valued today? Is it overvalued? Or given all that's going on, is it undervalued?
Let me just say this. Firstly, the conditions for a big decline, as I've said consistently, are just not present. The declines come about because of accelerating and problematic inflation. They come about because of a hostile Fed. In my opinion, the Fed is too easy, the furthest thing from hostile. It comes about because the market smells an oncoming recession. It comes about because of investor exuberance. And the market's been pretty darn disciplined. I got to give it credit. You know, I've given a lot of visibility, not that he needs it, he's deceased, to John Templeton, but he said bull markets are born in pessimism, grow in skepticism, mature in optimism, die in euphoria. And, you know, the only place I saw euphoria was the IPO market, but that's been corrected. You look at what happened to WeWorks, what happened to Beyond Meats, you know. So the market's been very disciplined. And I would say I think the market's fully valued, but I don't think the conditions for big decline are present.
Do you feel you don't feel like the conditions for a big upside run are there either? I mean, if I tell you, okay, the Fed is
well, you could
you
could get it, but I would say a big move from here quickly, 5, 6, 7% quickly by the end of the year. Call it 32.50, something like that. I think you're knocking on the door on euphoria, and I would get a lot more defensive. Personally, I think the big decline will come if we have a recession or if we see a big change in the Washington leadership, or we fail to get a deal with China, or we see a big spike in the price of oil. China and oil will dictate the near-term performance of the market. And oil has been very well behaved. And China, the president, seems intent on coming up with an acceptable deal. Beyond this year, I have to say I'm becoming concerned because I think the aggressive policies that we're pursuing are pulling demand forward, which should mean the returns prospectively would be less. So, for example, we have a reasonably fully employed economy, yet the deficit is going up. That should not be happening. The deficit should be going down. We're running a deficit of over $1 trillion. We're pulling demand forward. I don't understand. I agree with Eric Rosengren, I believe his name, and Esther George. I don't understand why we're cutting interest rates. The economy is growing a trend. Wealth is at a record high. Consumers are reasonably optimistic. Businessmen are buying back stock, which suggests they're not pessimistic.
Well, they're buying back stock because they're not investing their money elsewhere. That's one of the problems with the trade war, right?
Exactly. You know, in a perverse way, the slowdown of the economy was caused by Donald Trump, in the sense that he threatened tariffs. Against China, I understand. Against the EU, against Canada, against Mexico, I don't understand. Okay, this created a great deal of uncertainty in the business community. The business community did not know where to put their supply lines down. They didn't know where to build their plants, so they cut back on capital spending. Okay, once this clarifies, you know, CapEx follows demand. If demand rises and utilization rise, CapEx will pick up. But right now, the economy is being carried by the consumer. But we have a situation where the three major central banks are easing, EU, China, and America. Valuations are not extreme. Recession doesn't seem to be in the cards. Profits are rising, albeit at a more modest rate. So the conditions for big decline aren't present. And how you asked me how high is high, I don't know. But I would say 32.50 this year would represent to me euphoria. A constant theme I've had with you, and as recently as September 19th, is we're in an abnormal world. You know, depending upon the day, it's 12 or 15 or $17 trillion of sovereign debt with a negative interest rate. That doesn't make any sense. You know, lend money to Germany for 30 years and you get back less than you lent them? It's crazy. It's crazy. You know, and the height of stupidity is keep doing the same thing and hoping for. That negative interest rates for 3.5 years in Japan, it hasn't helped the economy. Those negative interest rates have been exported to Europe. Europe, with interest rates where they are, should resort to a $1 trillion fiscal stimulation plan to get their economy going. They're getting free money, but they keep dealing with monetary policy. And that's being exported to the United States. We don't need negative interest rates in the United States.
Lee,